All right, after a couple of volatile days here recently, the markets in the last few days have kind of bounced up nicely, and today really quiet. So, last time I talked with you, I mentioned this expectation of getting that 1+% pullback that we finally got, and then expecting some ups and downs, some quicker ups and downs. Not really a whole lot of, not a big move one way or the other. And I think today is kind of representative of that, where it seems like we're kind of running out of some steam on this first little up, and which might lead us to our first little down after this last after that a couple of days drop that we've had. And so we'll see how that plays out. But I'm going to kind of show you what I expect on how that will play out with the technical charts I normally show you, and then which way we might go after that and what to expect. We're going to talk about some of the patterns, the pullback patterns that we're seeing not only in the U.S. but across other countries and into the different sectors, and where there might be some opportunity within a strong sector, but an industry that is showing a similar pullback pattern too, and how we can be able to account for the possibility that it might not bounce and it might continue to the next layer of support, and how to incorporate that into our trade for today. So let's go ahead and get started. Today is Thursday, December the 5th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Notice that we got a light pink shading now over on the right-hand side, which means the intermediate line has turned below 80, down to 78.9. So, that's about as weak of a bearish posture as you could possibly get. So I wouldn't read a whole lot into it. You do see that we are currently in a near-term bounce. I also wouldn't read a whole lot into that either. I think we'll get some ups and downs since we had this big long rally in the near-term line that lasted multiple weeks, over 4 weeks. Actually ended up being over 6 weeks, or about 6 weeks, before we got got our first pullback, which wasn't very deep at all. Very, very shallow pullback, and then we bounced. And now we finally got that first 1% pullback, 1+% pullback here, and now we're bouncing. And since we went up 9% without, it'll be hard for us to really get going. Had this been like 5% and then a 1% pullback, then it's easier to do another 3 or 4% and then a 1% pullback. That's kind of how it normally works. But when you go 9%, over 9% without a 1% pullback, and you finally get one, it's hard to get going for another 4 or 5% again, because you used it, unless there's a trade deal, obviously, because that's what everybody's anticipating. That's why it goes up 9% without that pullback as we head into the middle of December. But look for some choppiness, especially this next 10 days, as we have headlines out that say how close we are to a trade deal, and as we have headlines out that say they're probably not going to do one. So that's going to probably stir the pot for either the up or the downward moves. You can see there's some resistance up in this area, and obviously we know where the support is, right around this 309 area in SPY, which happens to be the 23% Fibonacci retracement, as well as a volume support area. When you look at the Bollinger Bands here, you can see that right at the bottom of this volume node, we're in this volume node right now, so 309 is kind of the bottom end of this, and then 312, 313 is the top end of this. So you can see a breakout above, and we can get going. A breakout down, and we're talking about a move down to 301 as a possibility on the 1-year chart. So that kind of leads us into say, okay, well, that near-term line probably won't go up for 7 to 12 days like normal, that you'd normally expect on a normal trend, because this is a normal trend. It was a very front-end loaded trend, and now there's going to be some choppiness because of that. Again, big inhale, no exhale until this. Here you got a very shallow exhale. You take another inhale, and now it's really hard to breathe at that point. So expect some ups and downs. I wouldn't really, like I said, I wouldn't put a lot of stock into any bearish moves. I wouldn't put a lot of stock into any bullish moves either. I mean, again, we could come down all the way to 301. Remember, that's on SPY. That's where that big volume support is. That's also where the 50% retracement is. It's also where these old highs are. So, I mean, that's a big move. That's over a 100-point move to the downside, but it really wouldn't be that big of a deal. Again, only 50%, and probably wouldn't even bring the intermediate line down below 50, depending upon how fast it dropped down there and how long it took. and how quickly we bounced off of that level, which I would expect that we'd bounce pretty quickly off. If we dropped all the way down here, we'd probably bounce pretty quickly off of that, and we'd have a really high VIX and lead to a big bounce. So that's the S&P. The Russell 2000, and remember how it's got this breakout that's occurred here to above 1600. We pull back down below 16 or to 1600, and now bouncing off of it. All right, so but you also see it's really close to a weak bearish posture. Whether we get a yellow, in fact, I would expect here on the S&P too, there's the NASDAQ with the light pink shading. The Dow got the light pink shading and a yellow line. I would expect at some point in time we'll get a yellow line, which means that we've dipped below the moving average on any move down. See, this is about to cross above the 23%. So I would venture to guess. Remember, light pink shading in the yellow line is a very bullish pattern and a strong bullish trend. It's a buy the dip signal. So look for that, especially as this moves up above 1600 too, as we flirt with that old resistance as we come down. Don't be surprised if we don't get that bullish signal and bounce off of that, because we are really close to getting light pink shading here. So, keep that in mind. Keep that in your back pocket. Don't buy into any bullish moves. Don't buy into the bearish moves. Probably not for another week until we kind of base in here in this area, build up some volume as I showed you on the Bollinger Bands, build up some more volume in here, get a good solid base, and then we get going and bounce up to the top side where there's very little volume up there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here on the bottom right corner of your screen. Hit the red subscribe button that pops out. Also, hit the thumbs up icon down there. That lets me know you like the video, you want us to do it again tomorrow. Comment on anything that stood out to you. Subscribe to our website at marketscholars.com. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe for free. Excuse me. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching this on our blog, a reminder you have some other links on this page, including a link to our Market Outlook live video that we do at 3:30 Eastern Time, where we review all previous Market Outlook trade ideas, put on the new one for today. So we've already put on today's before the market closes. Also, our upcoming calendar. Remember, you get access to all of our classes with our Plus subscription that you see a link to right here above the video. Our premium subscription gets you all the classes as well, in addition to all the custom content, community access, and other things that you get, real-time trade alerts with our premium subscription. And we also invite you to engage with us with our social media accounts. Here's the Market Outlook tweet and Market Outlook Facebook posts. Again, the more you like them or engage with them, reply to them, retweet them, the more Twitter and Facebook will promote our content to the top of your timelines when you're not always looking at Twitter all day long. So that will just make sure that you get our stuff always. They will show you the content you engage with the most. So we try to make it really easy. Just click on this heart. Click on this heart right here. It will open up this window, hit like, or just hit on this thumbs up. It opens up the new window, and you can like the Facebook post from there. All right, so back to the charts, and you can see a transition candle developing here on the S&P. Now, I think we'll probably get a few transition candles, something like this, without the pullback, just because I expect that we'll continue this intermediate run that we've had. Though we've gone 1, 2, 3, 4, 5, 6, 7, now 8 weeks without a bearish candle, which is what usually produces the intermediate pullbacks. So, we're getting to the point where we're almost 2 months along. It wouldn't be out of character to get, out of timing to get more of an intermediate pullback now, especially with the PPO relatively high. If we do break the 50, a good chance that we could fill in the gap to the 200-day moving average, as you see plenty of examples on these other intermediate pullbacks. These are actually both market sentiment pullbacks, one that produced a death cross here. But at the very least, we could get another week, maybe 2. You can see there's like two, and then kind of another one there before we really took off again. That's kind of our best case scenario. I think our worst case scenario is something like this, where it takes a few weeks to test that 301 area. And then, like I said, if that happens, I think we bounce off of that pretty quickly. Let's take a look at the 3 green arrow charts. for SPX here. SPX, there we go. And you can see we got 2 red arrows. So, I mean, this is just simply a pullback. We're not even below the moving average. In fact, going to the 2-line versions of this, you can see we came to the 30, we bounced back up, and in fact, today we closed back up above the 8-day. So just like that, we are, and you can see we're pulling down here on the MACD, but they're both, it's still positive. The stochastics, and I look at the orange lines here because they're slower. You can see it's also pretty high too. So, and neither of the blue lines are below their midpoints either. So we're not threatening any kind of bearishness. In fact, this is a pretty decent pullback here that can set up a low point. So again, I don't expect a big drop to 301. It's possible, but I don't expect that. I expect that we'll kind of chop in this area up and down before we really get going again and consolidate more in this area and build up some more volume here before we break out on whatever the catalyst for that breakout is, even if it's just a seasonal Santa Claus rally, supposedly. I can see that pushing us towards 320, breaking up to new highs and pushing us towards 320. Let's take a look at the intraday chart, and you'll see again after dropping into the lower half of the chart, and that's going to be our low point. Well, we'll have a little low point right here. It looks like we got the 307.18. Let's see, 307.03 was a little bit of a low point for us there. Here, the low we hit was 307.13. So here in just another day, a couple of days, that 307 is going to be our low, and then just a few cents higher, that's going to be our low for quite a while. So that's the nice thing about this drop, is it's like I said, I have a feeling we'll chop in this area here between 308 on the downside and 312, 313 on the upside. So we're flirting with here. I would be a little surprised if we broke out of this already. I wouldn't be surprised if this little resistance hold at this point of control and we work our way back down in this area at 309, potentially even down to 308 at the bottom of that volume node before we find some support there, and chop back up to the upside, right? So ups and downs, and then that 315 is going to be there for a while, and now you'll have this 306. You'll have both. So I've shown you this Arun indicator before. Things really get bullish. Or these, whoops, no, I don't want to delete it. I just want to load it. I've shown you before where when both of those tags, those 4-week tags, are on the left-hand side of the chart, then that's when you have both lines down here, and that usually leads to a breakout. One way or the other, it usually leads to a breakout. Here was a breakout to the upside. When both of the tags are over here on the right, then that's when you have both of these lines apart, and you can see, they can kind of stay. Well, that's when both lines kind of come up. And like you saw over here, you had both lines up on the right-hand side, and that you can see what that leads to. And over here, you can see the same thing. You had both tags over here on the right-hand side of the chart, and that leads more. Now we're not that case yet, but like I said, here in the 4-week range, it's only going to take another couple of days, because that's got to come off before now you'll have it over here on this side, and depending upon that, so like I said, I wouldn't be surprised if we don't drop down towards 301. With a similar pattern that what I just showed you on some of those others. I don't think we'll get that big, deep intermediate pullback, that will bring the intermediate line below 50. But I do think we'll get back below the moving average. We'll get the yellow line. We'll continue to add the light pink shading, find some support, and then bounce back up and get going again at the Santa Claus time of year into the new year. Let's take a look at today's volume and trading range. So the trading range is well below the average, and the volume is also well below the average at 40 million. So both those numbers, if you put them in context, 40 million. We're still really low here, and the trading range is also really low. So and you can see the ATR to price ratio is well below 1%. So once we start getting moves above the 1% level, so that would, to get the ATR above 1%, you have to have moves consistently that are above 1% ranges. So up and down usually at the beginning. So that means that 3-point moves are higher. So we're looking at like 4 or 5-point moves is what it would take, a few of them, to start getting the ATR up above 3, which is right here. Then that would get this line up above 1, and that would be our pullback. And so I don't think, because you see this ATR is so low, I don't think that's going to happen. We might have a few that gets us to this point, but then that's probably it. And then, like I said, the volatility at that point would probably jump up towards the high teens, and we'd have a good opportunity. If you look at the trade after this really big compression and volatility last month, all the way down to 2.75. Right now, we're back up to 5.44. And if you look at the trading or the ATR for the VIX on a monthly basis here, you can see it's at over 8 points. So, with a high already at 18 and we get a couple more points, now we're right about at average. So if we get up to 20, maybe even a little bit above 20 on any more of an extended pullback, see, that wouldn't be out of the realm of possibility at all. If that drop here in these 2 days got us to 18, a drop towards 301 would definitely get us up towards 20 and get us up towards 1 here. We don't want to go too far. We don't go above 1.05 because that's what leads us to our intermediate pullbacks, right? So we don't want that. But if we can just stay right around 1 and cap off there like we did here in September, October, that can set us up for a bounce, a quick bounce. A quick move up, set the range, get the range up high enough, and then we compress again as we come back down and maintain our bullishness. All right, so that's my technical assessment of where I think the market is right now. What do you think? Do you agree with that assessment? Do you disagree? Before we move on to the next portion of the video, I want to see get your vote. Click that link right there popping out. It opens up a poll. Hit either agree or disagree. If you click disagree, let's get this conversation going down below in the comment section. What are you seeing that would suggest either you're a lot more bullish or a lot more bearish than what we just came up with our daily routine there? And share that with our market scholars community and market outlook viewers so we can have those different viewpoints down there. Of course, everybody's got their opinions, and I know people like to share their opinions, especially on the internet. But if you can share what's driving your opinion, what do you see, what indicators you see, what charts you see that's driving your opinion, that would be those are valuable things to share with each other. All right, now let's transition into what's driving the price action today. And it's really a quiet day today. I mean, if you look at how the different asset classes performed, and we just look at today alone here, I'm going to go over 10 minutes. Excuse me. You can see just how quiet it was. I mean, nothing was outside of 0.5%. Long-term bonds was down 0.5%. Emerging markets was up almost 0.5%. The dollar was down, so that lifts up emerging markets, which is... the dollar's actually been kind of dropping here. I don't expect that will continue to be the case, but you can see the market forecast has turned into a bearish pattern, dark pink shading red line. If we break this 97 level, 97 and a quarter, but if we break 97 or get to 97, there's a good chance now that we'll really roll over on the dollar. Now, keep in mind that there's this Fibonacci resistance area or retracement area that we've been trading in or trading around since that big deep pullback we had all the way to the beginning of 18, right? When everything fell. You remember, this is when the dollar started to rally and everything went to crap across the world, right? All equities everywhere and commodities and everything started to fall as the dollar rallied, which is typically the case. Well, we've rallied up to this retracement level, and you can see every time we've gotten these intermediate pullbacks, the kind of these levels of dark pink shading here and the red lines, we've gotten progressively higher, and we've gotten higher highs in between them. Well, here's one, this intermediate pullback that's also a higher low. We got a brief peak to the upside, but nothing more. And so now there's this issue of, again, if we break this level, and you see we've done this before, and then we just bounce right back up. So if we break this level now, we might start something like this, right, where we get dark, kind of a lower high and then a lower low, and then we start a downward trend, which is not a bad thing because that's really bullish. When the dollar falls like this was a 17, if you recall, that was a really bullish year for equities in general and international stocks especially. So it wouldn't be a bad thing for risk appetite. But if we do fall, kind of look for us to come down towards this 96 level. If you look at UUP on the Bollinger Bands to see where the volume is for that ETF that's supposed to track the dollars index, you can see there is support here in this area. So that's why I'm a little wary about us dropping. And again, wouldn't be surprised if we chopped up here. But look how there's very light volume below, at least on a relative basis, until we get down to 26, which is down to the low that we had post-June expiration. So go back to DXY, and you see that post-June expiration is right down in here. That would be the equivalent level of where the next layer of support would be if we were to break down on this basis. And again, you look at TLT, which is the inverse of TNT, right? So if yields continue to go up, which means this holds, we consolidate here. This descending triangle works as a reversal pattern instead of a continuation pattern. Then you can see how TLT's got room to run down to about 133 if we get back into this low volume area with another leg lower down to 121. If TLT falls that fast, and GLD, remember, is the other safety trade. If it kind of holds this little area, maybe falls because of lack of risk appetite, but kind of holds in this because the dollar stays relatively strong, then again, that kind of fits the narrative of risk appetite waning or strengthening, risk aversion waning out of these safety trades, but the dollar also kind of holding some strength in the face of relative risk appetite growing across these different equity asset classes. If the dollar falls and breaks that level, then look for, especially with TLT falling too, then look for EEM really to take off. It's been a struggler. It's been lagging behind. It's got this big resistance level. It's been fighting to get above. Once it breaks 44, it's literally off to the races. Remember, EEM peaked in early 2018 way up here. So you can see, you break 44, there is very little volume over the last 2 years up in that area. You put it in even more context here. And here, let's change this to a weekly chart. Then you can see again, there's that 44 level. And over the last 5 years, you got a lot of volume down below us. You got very little volume above us. It's got a potential for really taking off. But again, that's going to be highly dependent upon what the dollar does. And look how much support the dollar has as it starts to come back down. It's going to be hard for it to come down. So that doesn't mean that stocks can't go higher, but it's probably going to mean that there's a good chance that U.S. equities continue their outperformance, at least during this initial run. But one of the reasons why we've been so bullish is because when we rallied here, unlike what we saw last year in 2019, when we rallied here lately, it was a global phenomenon. Everything was bouncing up. We had dark green shading and green lines like this on Japan all across the board. Not the case right now. Light pink shading, almost yellow, light pink shading, yellow line. You can see some kind of pullback bullish patterns here. Some of these are more bearish than others. Korea's got the red line, but everything else is kind of dark pink shading and yellow lines. So with intermediate lines at 49 and 45 and 32 on Italy, a little bit of a deeper pullback. So everything is in some stage of pullback, and if everything bounces, then again that's a good sign for risk appetite, that it's going up across the board. If it only goes up in the U.S. and everything else looks like Korea and rolls over, not a good sign, right? As we've seen before, how that culminated at the end of 2019, 2018, at the end of last year, when the U.S. equities peaked in October and everything else had already been falling, and finally U.S. equities came down and caught down to all these other markets. So that's not been the case this year, and as of right now, everything looks to be in some stage, besides Japan, everything looks to be in some stage of pullbacks, and now we would look for everything to bounce, like Brazil already is doing, as it's now rising. The intermediate line is now rising, and we're getting back up above the moving average. If you take a look at the news of today, today's the trade data came out, and it had some impact on the markets. It was a much lower trade deficit than what we've had at the 50 billion mark, below the estimates. But you do have both imports and exports dropping on a year-over-year basis, and that's kind of a sign that we are still working through some economic issues. Korea being a good proxy for global economic trade. But when you look at the economic surprise index updated now, it's it's off of its lows, but we're really not very strongly positive. We pulled back here, and you can see still kind of -2 on the G10. So this number will go up before the economic indicators themselves really start coming up off of their lows on a macro level. And they are at their lows. Like from a broad macroeconomic basis, a lot of these year-over-year indicators have been negative and have been down, and contraction levels on the ISM, as we saw earlier this week with ISM. So a lot of people lately have been pointing to, oh, the economy is going to now, because we're seeing all these signs of weakness, the economy is going to be weak next year and into the year after. And it's like, wait a minute, have you, like, since January of 18 and really since August of 18, which is over a year, we have been declining on a macro level. And it's like just now everybody's kind of taken hold of that and thought, well, now we're really going to decline going forward. It's like, no, usually that means we're going to bounce. Now that everybody's paying attention, being late to the party usually means now we're going to build out a low point in these economic indicators, and we'll rally, and this will turn up, as it already has, ahead of it and get back towards zero. And then, of course, with rising yields, we'd expect that to be positive, this to lead those yields up higher. On a sector basis, you can see where our weakness is. I mean, look at energies, dark pink shading, red line, discretionary, dark pink shading, red line, real estate, dark pink shading, red line. Utilities has had a little bit of a bounce, so it's rising, but it had been dark pink shading and red line too. So obviously that's where our weakness continues to be, in these old interest rate sensitive areas that were doing so well when yields are falling, that have been struggling since yields have bounced. Energy has also continued to struggle, and you can see discretionary kind of struggling on its own. But you got pockets of strength still in technology, financials, healthcare. XLC has joined the party. Industrials has had that light pink shading in the yellow line pattern, along with materials, economically growth sensitive areas. So a bounce off of these little, triangle or pennant, or actually that would be a flag pattern on materials. A bounce off of these levels, off these really bullish patterns, would continue to move us up. You look at staples actually breaking out here, a safe haven area normally, but in this case, kind of more of a sign of consumers. I mean, that's where the strength is, from discretionary over to the staples. But lots of really good strong areas, but also lots of weak areas. So within the technology sector, which is one of those strong areas, there has been a pocket of weakness in that semiconductor basis. We've really pulled back. It's even got dark pink on applied materials with that yellow shading. But again, nice little pullback after this earnings pop, and then we pull back down, setting up a opportunity to bounce off of here and move back to the upside. You take a look at its Ichimoku cloud, and you can see we're below the blue line. In fact, the green line's pulled below the blue line, but we're still easily above the cloud, so it sets up for a bounce in that area. If you take a look at the Bollinger Bands for applied materials, you can see we are in this area where there is some room to the downside before we get to a stronger support, but we are at a support right now, so we can bounce off of here and move up. You take a look at the long-term view, the 15 200-day moving averages. You can see how we pull down to the 50-day moving average. When we are above the 50-day that far, we pull down to it. It's not too often that we go up above and we pull down through it, right? Usually it's hard for it to get to the 200-day moving average. You can see it's something more like this. That seems to be the case right now when we have this big, strong, but not nearly as strong as it has been in terms of momentum. So there's opportunity for us to bounce off of this and continue to move to the upside. From a 3 green arrow standpoint, you can see that we are flirting just below the 6-week moving average. We have the stochastics orange line down below, just like over here, without getting below 50. And the same thing, the blue line got below 50, but not the orange line on the MACD. And that's a similar scenario we have here, flirting with the 30-day moving average. So this type of bounce is what I expect to come out of it. Whether it happens or not, of course, who knows? But that's what I expect to come out of it. So we can look for a long vertical spread to get a good reward risk ratio on this. But also keep in mind too that on that Bollinger Band that there is another layer of support down here right about at that 52.5 level. That's where the top of the value area is. So the next volume node just below that. So not the strongest. The biggest strongest is down here at 40. But that's a relatively stronger than where we're at right now. So there's opportunity to take advantage of that too. So the way we can do that is we can say, okay, well, let's take a look at Applied Materials and let's see. Let's do that long vertical spread. So we'll sell the 60 by the 57.5. And you can see we've already done this in our Market Outlook Live session today. So we can buy that. And then you notice it costs 81 cents. I'm going to sell this 52.5 where that support is and cover the cost of that debit spread with the credit off of that short put. So now if it goes up, then I make my maximum gain on my long put vertical spread and I get that $100 of credit. I've done 4 contracts here, and the way we position size, I explained it in quite some detail in the live video today, but the way we position size is we said, okay, what's my maximum loss on the vertical spread, because that's, we kind of, when we look for 50% of that, we kind of position size around that. That's a consideration, just like it normally would be. And then on the short put, we think, okay, if I'm going to go for a $400 of reward, since it's a short premium trade, I'm going to risk $400. So when you combine that $400 with the maximum loss from the long vertical, then I'm right about half of my normal position size of my risk. And then you can say, okay, well, but that's more. I can lose more than $100 because it's a short put. It's got unlimited risk, at least limited down to 0 on the stock. So I can lose more as we go through that support. So the nice thing, the way that we're set up is my normal position size risk is if the stock drops below that support, then I will hit that normal position size risk. That smaller position size risk is right around that support level, $500, but that changes as time passes. So it buys me some flexibility. If we hit down there right now, then I lose $500 or half my normal position risk. If it goes through that support, if we kind of mess around for a while and then later fall through, then we can go through the support and keep my risk right around a half. If it goes through that support strongly, then I can get out at my normal position risk, knowing that I can double that with a move to the upside. Right, if we do get above 60 and stay above 60, I get that $400 plus the maximum gain on that vertical spread, which I can try to get twice the risk. And it's because I get credit here, that's a high probability trade. So, if we stay above 52.5, which we're at 58, but we don't stay above 57.5, there's a $5 difference there. If we stay anywhere in between, then I get $18 times 4. So that's my worst case scenario down to the 52.5 level. So it becomes a 2-to-1 reward to risk ratio essentially, with about a 75% probability of getting something, not necessarily my maximum gain, but at least something, and keep my risk, keep my losses small. So that's how we set up the trade for today. All right, and that does us for today. So as always, thank you all very much for coming on. You've heard from me now. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. That takes you to our Market Outlook forum, which you get access to as a free subscriber to our site. And let's keep this conversation going. If you have questions or comments for me, let me know in the forum there. And other market scholars can also answer, and we can be able to continue this conversation. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video below, follow me on Twitter for more content in between the videos, and join our community in our Facebook group that we've created for the Market Outlook. Have a great rest of your Thursday evening, everybody, and we'll see you all tomorrow.